Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Get it right. That's what we're going to do at 11 a.m. on the East Coast. Dan, Nathan, Guy Adami, soon to be joined by Elizabeth Young Thomas's work.
Oh, there it
through
is.
the lens of Mario. You'll see
You
what
got
I
me
did
all
there?
excited, Guy. I thought there was going to be like a special drop of EY.
By the way, we have a little house cleaning or housekeeping. What do you call it when you have to take
the house? Let's.
So there's some confusion out there, Dan. The market call you can find on the YouTube because, as we've said before, market call is a visual show. Is that correct?
Yeah, I mean, listen. So we made an executive. Well, Amanda made the executive decisions. We just do what she asks. We've gotten a lot of questions about this, and so at the end of the day, we think it's visual, as Guy just said. We kind of lean into charts, we lean into trade diagrams and the like here. So gonna live on YouTube. We appreciate you being here and doing that. The market call feed is kaput. Now we have Market Matrix in there, and we have Risk Reversal podcast. There are 2 podcasts. They are audio first. So go to the Market Matrix, MRKT Matrix. That is what, Guy? In under 10 minutes, we curate 10 stories of the business news, the economic news of the day that we think is most interesting. We have it summarized in Perplexity. We put the transcripts that Amanda ties together really nicely into a voice bot, and there you go. Under 10 minutes, everything you need to know about the trading day that drops after the close. So go find that in the market call feed, the Market Matrix feed, and help us out.
Yes, help us out. Do us a solid. By the way, any questions you have today, blow up Amanda's email or chat, whatever, right? I mean, I'm saying
all that stuff. It's in the YouTube feed. Guy, let's talk about these tariffs because there's some big moves. We were sitting on the desk of Fast Money last night from the Oval Office. President Trump detailing the tariffs, 25%. Also on auto parts. At the time, that wasn't clear, right? So it's kind of like nowhere near like a base case scenario. Don't you think? It's kind of like some of the worst case scenario sort of stuff. And at least GM is acting like it is, down 7%.
Yeah, well, let's throw up the little slide that Amanda made because it's an excellent one. And I mean, this is sort of a primer, I guess, in terms of what has been proposed and what will effectively go into effect. Was signed yesterday, goes into effect on the 2nd. And I guess the comment was we'll start seeing revenues flow in on the 3rd. All that remains to be seen in terms of the revenues, but the market obviously took notice, and it's taking notice in the form of the companies you just mentioned. I mean, Ford and GM obviously sold off pretty significantly. And, what I will find interesting, if you want to put quickly a GM chart up, I think there will come a point in time where there's going to be some rhetoric out of the administration to sort of, again, probably calm the waters around the U.S. automakers. So I think this is, it may not be today in terms of GM, but, there's going to be an opportunity to play this from the long side, understanding, in my opinion, there's going to be some conversation around those companies to, I think, stem the tide a bit.
There's a certain sense of irony about all this stuff, right? So if you're trying to, somewhat protect the U.S. auto champions, okay, you put these huge tariffs on. Let's just walk through how this works, right? So this is a tax, right, on cars that are coming into the U.S. that are made outside the U.S., right? And if you're at General Motors, and I think this is really interesting, let's put that slide back up. This is from Axios, share of U.S. sold vehicles assembled in the U.S., okay? So the top is Rivian. They only make their cars here. They don't sell a whole heck of a lot of cars. Tesla is up there too with the cars that are assembled here in the U.S. that are sold in the U.S. Like, this is important, right? But if you're GM and you're all the way down there at 52% of the cars that you sell in the U.S. are assembled here, that's going to hurt GM, right? Mm-hmm. So if you're a dealer, you have to buy those cars, you pay that 25% tax on those cars, and then you have the choice whether you're going to eat that, right, the differential, or you're going to pass it through to the customer. So GM is going to be adversely affected by this. Auto sales are going to be adversely, unless you're buying that 48%, that are made here. So it's interesting today, Guy, that you have GM down 7%. You have Tesla up 6%, which makes some sense. I just want to make one really important point. People in the U.S. don't want to buy Teslas right now. Like, that's just a fact. They don't want to buy them in Europe, and they're buying them much less in China. That's one of the reasons why the stock has been so hit in the last, few months or so. So help me think about that. If you're trying to encourage U.S. manufacturing, but the biggest tax is on GM, you're trying to support GM. How does that make some sense, guys?
What's going to happen? Well, I mean, because the pushback will be, it's going to force General Motors to bring all production back to the United States, and Ford to a certain extent as well. So this is what's going to wind up happening. You're going to hear conversation around, and at some point, you'll see people from Mary Barr or somebody from GM in the Oval Office making a promise by 2030 to have all production. And I don't know what it's going to be. All production, 85% of production done here in the United States. And that will be enough then, to I guess, again, use the term stem the tide around the market and probably sort of ease some of the concerns. So there's a game that's going to be played with this, I think, is how it's going to wind. Now, I might be wrong. I mean, that's happened before, but, that's how I think this thing is going to play out. It's forcing the hand of these auto manufacturers in some ways to basically construct and manufacture here in the U.S.
Yeah, and listen, I think we'd all be, in favor of that. There's a whole host of manufacturing jobs that would be amazing to come back.
Agreed, but there's a cost associated with that. So the 25% tariff you're going to pay, or the dealer's going to pay, or some combination of the two, or you bring manufacturing back here to the United States, and production costs will be higher by definition because you have to pay people more. So the cost of the cars are not going to come down if production is done here in the United States or manufacturing. There's a reason why these companies manufacture things outside of the United States. It just costs less. And, we've gotten used to, and this goes back to some of the things that Treasury Secretary Bessent has said, we've gotten conditioned or addicted to low cost goods. We've made those decisions, and that is true. And if we're willing to sort of go the other way and bring things back to the United States, which I think everybody in some way, shape, or form is probably in favor of, there is a cost associated with that.
Yeah, I mean, there's also a certain sense of irony that a lot of these jobs are going to be automated in the not so distant future, right? So the idea, I'm just saying, if you were encouraged to build an auto plant here in the U.S., one that is in Mexico, or and you got all this cheap labor, and you're bringing it back here, and you're committing to hundreds of millions or maybe billions of dollars to build this manufacturing capability in 2025 or 2026, when you start construction, you are not going to make these. So there's a whole host of thousands of workers working this, but it's going to be automated, right? And so then you say to yourself, you go back to that whole bank teller sort of thing when the ATM came around. Well, it gave the banks a lot of opportunities for those people who used to kind of take your check and give you the cash and this and that, or whatever, right? They gave you the opportunity for like selling more products, and you put them in the bank, all this sort of. I don't think that goes with manufacturing. I just, and when you think about the pace in which AI is moving and the pace in which robotics are and all that sort of stuff. So to me, I think there is a trade-off here. You get the cheap goods that are made outside the U.S., half of them, if you're GM, are made here in the U.S. And, listen, the gutting out of those manufacturing jobs, in middle America, that is something that I'm not sure putting some auto factories back, because then you start talking about the unions, you know what I mean? And what they've done. And then you start talking about these unfunded pensions from GM, right? And Ford. You bring back manufacturing here, you have these unfunded pensions. It almost only costs more to make these cars. It's not that much easier to fund them. So whatever. I mean, I don't have the answers. You don't have the answers.
I certainly don't have the answers. And quite frankly, I don't think anybody really has the answers. I think they're going to try things until they think it's working. And I think, and look, we're not here to pontificate about the impact of tariffs. We're here to pontificate what it means to the market. And through the lens of the market today, obviously the auto companies don't particularly like it. But what seems to be interesting, and again, I used the word that I said I wasn't going to use yesterday, markets reversed a little bit here. So let's throw up the S&P chart, because
before we do that, Guy, we have a call of the day that's closely tied.
You want to jump that in?
Tesla. Okay. Yeah, and I mean, listen. So Tesla's up 6%, right? So GM's down 7%. So this is HSBC. They're slashing its Tesla price targets. These shares falling more than 50%. I like this guy. Michael Tyndall. We got to get him on the pod, Amanda. Reach out to him, please. They reduced the price target on the shares by $35 to $130. His new forecast suggests 52% downside. The seeds for the current sales weakness predate the recent brand issue. We've been detailing that for years now. There's been a price war going on. There's been some nationalistic tendencies as it relates to the buying of cars in China. That is before some of this brand stuff. What's going on in Europe is brand stuff. What's going on here in the US largely is brand stuff. But it's not just brand stuff, Guy. It's basically the incremental buyer of an EV might be saturated at this point. And then Tesla's cars, they're a lot more expensive than a lot of these other EVs that are coming out right here. So when you hear an analyst, and the analyst community, let's be clear, they're pretty mixed on this. Half have buys, half have hold or sells. You know what I mean? And again, if you're an auto analyst, maybe you can't get your arms around Optimus and Robotaxi and all that sort of stuff. And maybe you're just focused on it as an auto company. But when you see an analyst give that sort of downside, and you could say maybe he's just been a perma bear, but we'll go back and I'll look in the fact set right now. What he's had is what does that mean to you, Guy?
Well, I think you just said, you laid it out. I mean, think about it. High in the street's 120, low on the street, high in the street is 1,000, low's 120. You can drive a truck through that. The average price target is, not somewhere in the middle, but sort of the lower end, 360 or so. And I think for me, it's a bold call. And we had the Jefferies analyst on, I think, Fast Money last week that made a similar call. I think his price target is about $1.40 or so. And, I think we've been pretty clear when we got down to those levels we saw last week and a half or so ago. We talked about it probably not being a good press to the downside. The fact that we traded down to the pre-election lows made sense in terms of looking for a bounce. We actually said 285 was reasonable. We're trading there now. The overshoot, if you want to play that game, it probably gets you to sort of 330, 340, which would be a 50% retracement of that all-time high in this recent low that we just saw. So the reasons to trade around the edges, but if you want to look at it just through the fundamental lens, I think it's a company that continues to be challenged. And we've talked about that for a while. I mean, we're going to hear about deliveries over the next week or so, I guess. We saw the last quarter where margins were miserable. So, I don't know really what they're going to be able to say in the next quarter that's going to sort of alleviate some of the concerns that the marketplace has. I mean, competition is coming. There's obviously a bit of a problem in terms of the messaging coming from the company. I mean, it is a challenged company right now, without doubt.
Yeah. So interestingly, just to be really clear, this guy's been a perma bear. He's had a reduced call. So it's not a downgrade or anything. He's had a reduced rating, which is basically a sell rating on the stock going back to late 23. So I don't know if that's as far back as the data is. And his price targets have been all over the place, but normally they have a one handle on them. So for whatever that's worth, and the last thing I'll say is you were targeting like a 285 level on a bounce a week and a half ago. We were saying this is not a great stock to short, not to press it on the long side, given the April 2nd delivery number, and the delivery estimates have been coming down fairly dramatically over the last few weeks or so. So once you have that sort of happen, like if they're not as bad as expected or they come in line, you have a stock pop. But the higher it goes, Guy, into April 2nd, the kind of less likely I would be to play it from the long side anymore. You say, well, it was just at $480 2 months ago. Yeah, but that had nothing to do with fundamentals, in my opinion.
Yeah. And, you could see a situation where it continues to sort of levitate. We got a quarter end, whether that quarter end is this Friday or Monday. I don't know how people's books line up, but you can see some weird things going on into quarter end without question. And then we'll see how it plays out. But to your point, if this thing continues to levitate towards the end of this week and then early next week, I think it becomes more and more likely that it's going to be challenged for that move to continue. So if you're asking me how to play the stock, if we close above 285, let's say today, maybe it does make that 50% retracement. And then I'm looking for another place to figure out how to short the stock. And I think we've been pretty consistent, on the ebbs and flows of this name for sure.
No doubt. Now let's go to the S&P 500, Guy. We were talking about this 200-day moving average, kind of this level here where the S&P bounced back to at the lows about a week and a half ago. We were down 10%. Liz has got some great data and Mario on that, so we're going to hit that in a second. But the thought here, Guy, it kind of got rejected at that 200-day. We were also talking about that 5,800 level that was support, going back to November. It was also that high last summer. So we think that's kind of an interesting technical level. And the fact that you have the 200-day lining up just below that or so.
I look at it, and there's going to be, I think what's going to wind up happening here with a flattening 200-day moving average, this is going to be a bit of a battle line, right? So there's a very good chance that we sort of plus or minus 75 handles on either side of the 200-day moving average for the foreseeable future. When I say foreseeable future, into and out of maybe next week. So the first week of April into maybe early second week of April, where we're trying to figure out, if we're going to fail here or if we're going to sort of hold and then bounce. I think we're going to fail here, but it could take some time for the market to figure that out, especially with the moving average sort of flattening out, which is one of the reasons I think volatility is still going to be a bit of a theme here. And I think you're going to see days where things look like everything's fixed, and they're going to be days like yesterday where everything looks broken. And I think when you come back a week from now, we could still be at the current level that we're at right now.
All right. So a week from now, Guy, on April 3rd, are we going to be thinking about that jobs report, the all-important March jobs report, and talking about this potentially being a big mover for the market?
Yeah, and I think it's not going to be particularly, this is just my sense. I think you can see a continued uptick in the unemployment rate. I think people are going to sort of dissect the numbers, and there could be some inflationary aspects within the numbers, if that makes sense, maybe wages and those types of things, which I think creates a bit of a problem for the Federal Reserve. I think the unemployment rate is going to be a story for the remainder of this year the wrong way. I think most people will think that bad news will be good news for the market, but at a certain point, bad news is in fact bad news. And, you're still talking about a 10-year yield, which has made a pretty significant move off that sort of 4.11 low in terms of yield that we saw a couple of weeks ago. So, yeah, I think it's a really important number, but I don't know if people really want to know I don't think people know what they're rooting for, if that makes sense. I think a lot of people would root for a terrible number, thinking it brings the Fed into play, but I think a terrible number could be terrible for the market.
Yeah, a Fed into play. And this is one of the things why we've been talking about it for over a month, the kind of targeting of the 10-year yield. I mean, the Fed into play, that means that they take the Fed funds rate down from 4.5% on the upper band to 4.25%, or that sort of thing. And we've already seen some really interesting movement over the last kind of year or so that's basically gone the other way from what the Fed is doing with Fed funds as it relates to U.S. Treasury yields and the like. To your point about, an uptick in the unemployment rate expected to be 4.2% on 120,000 jobs added. Last month it was 150, which was less than expected. So your point is it's been going in the wrong direction. And at some point, this focus on inflation might go the opposite way too. But I don't think you think that. You think inflation's going higher. We had Chris Harvey on last night from Wells Fargo on Fast Money. He doesn't say, I couldn't really tell. He didn't have a lot of enthusiasm one way or another. He's got a bullish call on the S&P, but he doesn't seem that worried about inflation. And it's interesting because a lot of strategists, for the most part, Guy, don't feel particularly worried about inflation. And I wonder if that's one of the reasons why it gives you more confidence that, that folks are not focused on it.
That is that people have been pretty dismissive of it. I don't know how they can be, given you're 4 years into this thing. I mean, how long ago was it when you heard the term transitory when they were describing inflation, and where are we now? I mean, look, for most people, it is clearly still a problem. And I think to a certain extent, if you sort of look at the numbers, that the inflation numbers, whether it's CPI, PPI, or any number you want to throw out there, they continue to be problematic. I mean, people will say it's trending in the right direction, not nearly as fast as I think most people would have thought a couple of years ago when the Fed went on this rate, height cycle. It helped. It did not cure. And again, if you somehow think that lower rates are going to solve all the problems, I think it's just going to let this inflation genie right back out of the bottle. So I think they're a little pigeonholed here. And I think Amanda's about to put up a yield chart. Yeah. I mean, you can see, you tell me, like, this is probably a pair of twos here. You have a flattening 200-day moving average. We traded below it. We traded above it. This is the absolute yield. There's a reason why yields are as sticky as they are. And it's not because the economy's doing better, Dan, in my opinion. I think you would agree with that as well.
Yeah, I mean, the more data that we get, and obviously, as we get further into the month of April, we're going to get CPI, PPI, PCE, that sort of thing. So, but the tricky thing, Guy, also is that once we get we're bracing for all that macro data in the face of tariffs and a trade war, when we get to earnings season, which is going to start with the banks, I want to say in April, 14th or 15th, maybe a little later, man, what they have to say about the consumer, what they have to say about some of the things that you've been tracking very closely, delinquency rates and, and a whole host of other things, charge-offs and, consumer credit and, that sort of thing. That's going to be really interesting. And then when you kind of get into some of these industrial names, when you get into some of these big, tech names, the clarity that they have on their guidance, this could be a really, really messy period for the stock market.
Well, you're talking about tariffs yesterday, and there's sometimes things happen at the right time of the cycle. Some things happen at the wrong time of the cycle. So, and again, please, this is not in any way political, but we're embarking on this tariff strategy with automakers at a time where it's pretty clear the consumer is feeling the pinch. So do you really want to put that kind of burden on an already burdened consumer? So, I think this might sort of tip the scales the wrong way. So you could create the problem that you're trying to fix in the first place. So sometimes things happen at the right time. If we were at a different part of the cycle, maybe these tariffs make a lot of sense. But we're at a part now where I think there's a vulnerability to the economy that this potentially could be the tipping point for.
Yeah,
we'll see how it plays out.
But going back, Guy, to earnings and guidance, you just mentioned the consumer. It's the wrong time to put this sort of tax on them as it relates to autos. Yet it ends up probably being more of a problem for the automakers, for GM, right? Because they might have been ordering a lot of inventory in front of this. If
That's
the economy
right.
is weakening, then the consumer is less likely to buy a car anyway. But if you're telling me now the average car is going to be $4,000 more than it was, and GM's not going to, kind of eat those expenses or eat those costs, then you have a situation where they end up with a lot of it looks a lot like post-COVID, I guess, is really what I'm saying. So, and we know what the hangover looked like. All right. So, Guy, you teased it. Elizabeth Young Thomas, she's not here, but Mario, her main man, he sent us over a bunch of data that he wrote in their weekly note. You can find it on the SoFi blog. Let's just do it without Liz because, SoFi.com/on-the-money. You can find their blog there. I'm sure you can sign up for it and have it in your inbox. God, let me rip through some of these. We're going to call them the charts of the day. Okay, so this is S&P 500 returns and drawdowns. This year, peak to trough drawdown from February 19th to March 13th was 10.1%. Historically, that's not that big of a drawdown. Since 46, that'd be 1946. Guy, you remember what you were doing back then. The S&P 500 has experienced an average intra-year decline of 13%, with the market seeing a double-digit percentage drawdown over half the time. Against those stats, this year's drawdown might even appear mild. Thoughts on that?
If this is in fact the end of it, yeah, it is mild, but it comes at a point again when I think we're just at the beginning of something. So I think what they're trying to outline here is, in this, this leaves the interpretation to the reader, to the viewer. Like, where do you think we are right now? You could say, this is mild and all systems are go, and we could see a reacceleration. Or you could say, wait a second, let's just see what's going on. Let's sort of take the pulse, the temperature of the marketplace, and does a 13% or whatever drawdown we've seen make sense? And I would submit, no, it doesn't make sense, especially with the valuations that we have. And I think theoretically there should be more pain to come. And if you look at historically, it seems to happen over a series of periods of time. Like, there's brief interludes, and then you have these big drawdowns. And you just go back. I think the last one was 2008 or something, when you had that significant one. So, it's sort of like the earthquake thing. You sort of do. You can't time it, but you sort of do. And I think that's what we're looking at here.
Well, thinking about so let's talk about COVID. We don't have to talk about the COVID decline, right? That was March, April. By May,
short-lived, yeah.
And God, black swan event, that sort of thing. But also the fiscal and the monetary stimulus that went into the markets and the economy. That was like a free-for-all. Then you have to go back to 2018 Q4. There were growth concerns back then. There was also a trade war going on back then. And to your point about not being political about the timing of the tariffs and everything like that, I've said this, they've done it ass backwards. Back in 2017, they went for your main man, Gary Cohn. He came in, he's like, one goal, to get those tax cuts in, corporate, right? And then the whole trickle down, consumer sort of thing. They got it. That gave a tailwind to the economy. It gave a tailwind to the markets, and it gave them a little bit of a buffer to play tough on the trade front, on the tariff front. But what happened in Q4, as soon as we saw some kind of growth issues, how much did the stock market sell off?
19.9%.
19.9%. And then the Fed had to pivot because they were already getting tighter. Then they had to pivot. And then the stock market was raging, right? So between now and then, those were the two big sell-offs. We know what the Fed had to do in each indication. But what you're saying right now, if they were to take a play out of that exact same playbook, given the difference in inflation and the likelihood that this trade war probably goes on longer, geopolitical stuff, it's not going to do the thing that they think that it's going to do.
I don't think so. I can understand why people would believe it's going to be the same again. Like, why fight what we've historically seen? I just think the data set is a lot different. And it's interesting. I'm sorry.
No,
It's
dude, it is
riveting
interesting.
that if you go back to the early 1970s, and some people have made the comparison between what we're seeing now in the early 1970s. And if you remember, the Fed chairman there, Arthur Burns, thought he had defeated inflation only to see it come raging back. And you saw the subsequent moves in the market. And I think there's some of that going on now. I think Jerome Powell wants to be careful not to be this generation's Arthur Burns, but he might be forced into being that person. And so there's a lot of things here you got to take into consideration. So I look at this and say, we're probably due. Let's look at the next one, because these are some fascinating. This is now relative to Europe and some other international stocks, and you can see, and we've talked about this. If you watch Fast Money, Tim Seymour's talked about this. As a matter of fact, he coined something called MEGA, Make International Great Again. And quite frankly, that's exactly what's been going on for a period of time.
Yeah, it's a little lazy of an acronym.
Yeah, I know.
I'm just going to be really clear. It's not like the Fateful Eight, which is multi-layered. You know what I mean? That sort of thing. All right, let's look at this chart, because I agree with you, Guy. It is interesting. Okay, S&P 500 quarterly returns versus other assets. Broader international markets are having their best quarter versus the S&P 500 since Q2 of 2009, while U.S. bonds are beating domestic stocks for the first time in nearly 3 years. Since we are coming up on the end of the quarter, the possibility of a big portfolio rebalancing moves loom large given the divergence. Okay, so let's take it first into U.S. bonds, okay? Because again, we've been talking about this since rates have been higher. There have been an alternative to stocks over the last few years.
That is true, and obviously into U.S. bonds mean yields have been going lower. And I guess if you look at it through the lens of that recent 4.8% that we saw in 10-year and all the way back down to 4.11, that makes sense. But I think the question that the market's going to struggle with is, wait a second, is there safety in the? First of all, I think we've established that the valuation safety in the stock market is not there, and sort of the tape bombs exist. But there's also a concern, I think, around the bond market in terms of what can happen, and some of the things that I've been mentioning now for a while. One of the reasons why I think the bond market can sell off as well. Both can be true. But a rebalancing at the end of the quarter, I think that's what I alluded to earlier. Whether it's this Friday or Monday, you could see some strange things happen over the next couple of days as we get into quarter end.
Yeah, no doubt. And then on international, really quickly, I think Amanda has a couple charts, because I think this is something that's worth kind of noting. When you look at the Euro Stocks 50, okay, so that's 50 stocks across the Eurozone. You see what's going on here. There was that long consolidation. You can look at that kind of 5,000, 550 or 50 level, right? And then you look at that 200-day moving average, guy, it's about 5,000 or so. So you had that really nice moves to start this year out. The euro has probably had something to do with that, right? And then you look at this 200-day flattening out, you look at this consolidation, maybe it's kind of running out of steam, Guy. I mean, maybe you don't want to look at that flag and say, it's making a series of kind of lower lows, but the one that's really sticks out to me is the Euro Stocks Bank Index. Look at this thing. This is the SX7E. It bounced off that 200-day moving average, which was a little below 150 or so, and it went from high 140s. Look at that. So talk to me what you're seeing here.
All right, so go back 2 slides, Amanda, and let's look. U.S. stocks are still expensive relative to international stocks, and that, to me, people will be like, how can that be possible given this run we've seen in international? The reality is a lot of these international markets, specifically Europe, have been underperforming now for multi-decade, 10, 15, 20 years. And a lot of people, I think Tim Seymour would say it, and Lori Calvasina said it on our podcast and on Fast Money, I think a month or so ago, that she thought we were in the early innings here. So as much as people want to say potentially the run is over and maybe it'll sort of stall out a little bit internationally or in Europe, I think we're just sort of at the beginning of something. And you could see continued flows. Didn't Vinny Daniels talk about it the other day on our podcast? He said the irony about making America great again is you might have forced people into investing in other countries. And that's true. I mean, in terms of the things we just sort of outlined.
Yeah, I mean, listen, it seems like a crowded trade though at this moment, and you see where the dollar is. Maybe it's firming up down here if you look at the U.S. dollar index, but I think some of the data that Liz put forth here at the end of 2024, the S&P 500 had a forward 12-month PE of 21.6. You and I were talking about this yesterday. You were doing some quick math here, right? So at $270 in expected S&P 500 earnings this year, it's up double digits percent. You're getting about 21.5 times. Our main man Butters over at FactSet, he's been charting this data on a 5 and 10-year basis. That is expensive. But if you look at, let's say you go to 230, I think Larry McDonald, we highlighted that. Well, then you have a 25 times. So that would mean a massive earnings recession. Is a trade war and lower growth the sort of thing that could do that? Possibly. We did have an earnings recession back in 2022. We never had the economic recession, despite that rising rate environment. But you can see how if corporate earnings are adversely affected by a protracted trade war, a weakening consumer, a housing market that's kind of locked because where rates are, well, all of a sudden S&P earnings are going to go to 260. They're going to go to 250, and the S&P looks expensive.
And well, it looks expensive now at current estimates. Imagine what's, to your point, imagine what's going to look like if, in fact, we see that contraction down to levels that make a little more sense. And why would you be paying that kind of premium for markets that may be under significant pressure? I mean, the historic norms, by the way, I think people forget, is somewhere around 17 or so. For some reason, that seems to be lost on a lot of people. I mean, we've been north of historic norms now for quite some time. There will be a mean reversion at some point. This is a question for you, Dan. This is right up, by the way, you've been talking about this, full credit. But Gary Webb, do you have an opinion on the CoreWeave IPO? As we outlined in our notes to each other earlier today, it looks like they're sort of reducing that IPO. And that's a bit of a problem. It's something you've been concerned about for a while.
Well, there's so much hair on this thing, and we've been talking about it for over a month. And we don't have to get into all the specifics, but there's probably no shortage of articles that are going to detail this. But we've been talking about the debt levels. We've been talking about the sustainability of the growth rate. We've been talking about the reliance as NVIDIA as a supplier, which has also financed them because they invested $100 million. And what do? They turn around and bought NVIDIA GPUs. We're talked about the reliance on Microsoft as a 62% customer, and there's been no shortage of news reports over the last few weeks that Microsoft is cutting some of their data center leases. That means from CoreWeave. I mean, the list goes on and on about insider selling, about a secondary by some of the early shareholders. This company is trying to buy a data center, like another supplier of it's just really hairy. They were originally going to raise between $3 and $4 billion at possibly a $32 billion valuation. Now they're talking about $1.5 billion being raised at a much lower price point. So if the market gets a little funky here today, Guy, they pull this deal. It's not being done overnight. That could be one of the worst possible things that they could do for the generative AI trade, in my opinion.
Well, it's going to send some messages for sure. And more people starting to talk about the things you pointed out now for the last few weeks. This is from Michael Graham. This is a question we've gotten a couple times. I will try to address it. Why are we going back to the 200-day again? I thought we switched to the 150. So when we first started doing the show, we used the 200-day moving average. Carter Worth has historically used 150, and we saw sort of the merits around that. His work was all 150, and it made sense to us. We've talked to some people, and we've come to the conclusion that I think for the audience that we're serving, 200-day might make a little more sense. It's really got nothing other than that. I mean, quite frankly, you can say you're splitting hairs, and to an extent we probably are, but we just thought the 200-day was a little bit cleaner.
Yeah, let me just give my 2 cents. So, Guy and I have been looking at charts, me for almost 30 years, you for a bit longer. We think of them as more of an input to our broader sort of thesis, right? We'll usually start with a catalyst. We'll start with some fundamental news. We'll look at valuations, the management, the modes, so, all that sort of stuff, right? We create a big mosaic. And then the charts can be really helpful to just think about levels where other people have been buyers, because that's called support, where there's been resistance. That's where the sellers are. We use it to kind of inform strikes, whether it be in options or futures and the like here. For me, I'd always use the 200-day moving average. When Carter was doing a lot of work with us, he uses the 150. He's the technician. You know what I mean? Guy and I will defer to him. But for me, the way in which I look at charts and the way I use them as my input to the broader thesis, I like the 200-day. I find that If more investors are focused on the 200-day moving average, then it probably makes a lot of sense to kind of look at those levels, because they're basically, to me, more informed from a broader swath. So Gary, love the question. Guy, let's do a call of the day. This would be AMD, Advanced Micro Devices, downgraded to hold at Jefferies. Target cut to 120 from 135, 9% upside. Facts at average target 146.6, range of 90 to 225. The analyst is Blaine. Blaine Guy with a Y. B-L-A-Y-N-E. If you were going to be a Blaine, would you hope that your parents did it that way, or B-L-A-I-N?
I dig the why, but I mean, I'm probably a bit of a more, I go back and look at sort of historical norms. So I would be a B-L-A-I-N-E, Blaine.
Yeah. So Blaine with a Y is kind of the dumb way to spell it. Bill, I hope you're paying attention.
Maybe it's a family name.
Flip-flopping it. Yeah. But like, to me, I would almost think that the name was Curtis Blaine, which would be actually a much cooler name, in my opinion, if you flip-flop those. Curtis Blaine, you know what I mean? Sounds like he could be like a power forward, like for the Houston Rockets or something like that.
I like what you did there.
All right, let's talk about this, because I think on AMD, you've been very consistent, and I'm laughing because, like, I don't think you've had a nice thing to say about this company in 2.5 years, maybe.
Well,
I think you always say, I like Lisa Su. She's been a great CEO. She did a lot of great things against Intel. But what does she miss, Guy?
Well, I think the AI world might be sort of slowly passing them by. This got sucked up in the AI world. If you go back to the spring of last year, where everything was going higher, if you were in the semiconductor space, you were getting dragged up. And we sat here and watched the stock go to about 207 or so, and it didn't make a lot of sense to me then. Quite frankly, the level that it's trading at now doesn't make a lot of sense to me either. And since that point, I mean, this is a stock that's effectively been cut in half, and probably rightly so. I do think there's support in the name, but I think the support comes in the mid 90s or so, and we're just not there yet. So I think there's downside. It's not an indictment. It's more of an indictment of the valuation, but it might be an indictment of maybe the world's just passing them by a lot faster than people realize. What happened in the spring of last year made no sense. This makes a little more sense to me. Getting down to 95 effectively round trips the entire move we've seen over that period of time.
All right. Before we get out of here, Guy, let's just talk really quickly what I see on my main board here on my FactSet screen. I have about 300 stocks. They're maybe a little more divided by sector and the like. And I just want to do a really quick run through the Fateful Eight. You have Broadcom has acted so badly.
Yeah, we have a question about Broadcom, since you brought it up. Yeah. This is from Chris E. What do you think about Broadcom here? And, in looking at it, I thought we would stop around 185, 190 right after earnings. And we talked about it on this show a couple times, but since then, it really hasn't done all that much. I mean, it did stop the first time and it bounced, but now we've broken through. So I guess if you really want to get down to brass tacks, 160 or so, that prior low in December comes into play. I still think you can make a compelling case on valuation. And the fact that we've more now than round trip to move from December, I think is a little bit concerning.
Man, I got to tell you, for a whole host of reasons, I look at that 40% move in December, and you and I were saying at the time, Hock Tan, the CEO of this company, you could have driven a truck through that $60 to $90 billion TAM for custom silicon that they talked about. And, investors bought it hook, line, and sinker. It just told you where they were, that they were looking for anything in way to play this generative AI, and brought it out from NVIDIA. So let's be clear on that. The fact that it not only, to your point, filled in that gap, but now on a 2-day basis has dropped, nearly, 8% or so. It just tells you that folks are coming out of that. From a technical standpoint, you didn't even need to draw an uptrend. You could just look at that 200-day moving average that we held there a few weeks ago. We've blown through there. So the Fateful Eight not acting particularly well, other than you have Tesla that's up 4%, which was up 6.5% when we started talking about that. That's the one today here, people. In my opinion, you want to keep a close eye on. GM is down 7.5%, so it's getting back towards its lows. If Tesla gives it up, this whole idea that they are to benefit from these, taxes or tariffs or whatever you want to call them on GM, interesting. The SOX guy down 2%. sucks. Taiwan Semi down 2.5%. Marvel, I think this is Marvell, really important because they're also in the custom silicon space. That thing, guy, has barely seen an uptick since they reported right through Broadcom. Software kind of sucks. Internet names are doing okay. I'm looking at Reddit. This is maybe Amanda can pull up Reddit for a second. This is one you and I've been talking about. Became a meme stock. It was an IPO of last year. It was one of the IPOs are the names that people were pointing to. Why tech is ready to get the IPOs back going. It became a meme stock. Look at it. I mean, I think it's an interesting technical level. Anything that sticks out to you outside of tech? Retail's all green here, guy. Banks are down. JP Morgan down 1%. Goldman and Morgan, keep an eye on these. They were lead on this CoreWeave. They can't get this deal done. I think the perception there is bad. So
no, I'm going to look. I think you're right to point out like a Reddit Palantir is going to look pretty similar to that. I think we're coming on, as you said earlier, a couple of weeks from now, we're going to start to get bank earnings. There's a lot of enthusiasm around banks, I think, for the wrong reasons. But I continue to sort of keep a keen eye on yields and to see where they go. I mean, 431, I think, as we're sitting right now, 432 in the 10-year. The market seems to be sort of ho-humming that thing right now. But I think it's, I think the ho-hum, are we even higher than that right now? We're about 432 or so. So I think the ho-hum period is in for a rude awakening at some point. So TLT is something I continue to sort of watch.
Yeah, and you've had that one down, man. We had to kind of cut that position, or at least my position. Long calls in April was the 91 strike. It hit our premium stop. We did that yesterday. We talked about it on the market call. Anything else here? Anything else before we cut out? Oh, what about airlines, guy? Really quickly, is this more reflective? I can't see anything in the trade and tariff war, but is it more reflective, like on a day like today, of just kind of growth concerns, consumer?
I mean, if you think about business travel, it's such a big component for a lot of these airlines. I mean, if things are slowing down, if their jobs are being lost, especially government jobs, I mean, it's going to weigh on business travel at a certain point. So I think there's a concern around that. I do think there's a concern around some of the geopolitical stuff. I don't think people are as sort of keen to travel right now for whatever reason. I think one of the reasons is because they're probably strapped. So there are a lot of headwinds right now in the travel space through the lens of the airlines. But, Tim Seymour talks about it. I know you hate the term. You just got to find levels to trade around these things. And, for a delta, if you want to throw that up real quick, I mean, we're getting towards levels where you want to start looking to play it on the long side, I think. If you go back and look at, where we've bottomed out over the last, year, 2 years or so.
Yeah, I mean, we found it pretty astounding the way in which those stocks have. I mean, look at that. That's a great example to just kind of look at the peaks and troughs. And from a trading standpoint, yeah, man, you kind of go one way and you kind of keep raising your stop, and it's been a great trading vehicle, as Tim likes to say. I just think from an investment standpoint, it makes it really hard. You know what I mean? If you have a longer term view on these sorts of things. So I think it's always interesting to kind of take a look and see why these things are acting the way they do. And in a market right now where the stock has absolutely gone from 70 down to current levels here, it's pretty astounding. All right, should we get out of here, man?
We should, but tomorrow's Friday, so you won't see us, but you will see us on Monday. We're talking to Mr. Brian Belsky in a few hours. That'll be fun. That'll drop tomorrow. We got a lot going on.
Yeah, we got a lot going on. So we appreciate everyone being here. We appreciate Liz and Mario's work from SoFi. I hope we got your money right, all in one TV show, one streaming show here. But check out the Belsky interview. He's the head strategist at BMO Capital. He's very animated and got a lot to say here. So that drops tomorrow morning in the Risk Reversal Pod. Also, remember, Market Call no longer in the audio podcast stores. So if you're watching it here, make sure you're subscribed. You can set alerts Monday through Thursday, 11 a.m. We appreciate it, Guy. I'll see you a bit later.